There's a number that shows up on your cap table, and every operator in the room thinks it's the price of the company. It's not. And by the time you figure that out, you've either made money on it or you've quietly given a bunch of it away.
So here's a question a lot of tech operators are asking right now. Your company just closed a tender. Great. You wired some money. Your neighbors are happy. And here's the industry list that should make you sit up. AI infra companies running $50 million tenders. Fintech unicorns doing quarterly windows. Late-stage marketplace companies letting employees clip 20% while the primary round is priced somewhere entirely different. Different price, same cap table.
You have to understand which one you're looking at and why.
Okay, so if the number isn't the price, then what is it?
Let me say that slowly. A tender price is the clearing price for liquidity at a moment in time for a subset of holders under a specific structure with specific tax and settlement mechanics.
That is not the same thing as the marginal price of new primary capital, which means the tender can be lower than the last round and the company can still be worth more. Correct. And it can also be higher and the company can be worth less. Sit with that for a second.
That's uncomfortable.
It should be, because the whole point of a company-sponsored tender under the SEC's tender offer rules is to give specific holders a structured way to sell into a defined pool of buyer demand.
Early employees.
Sometimes founders, sometimes early angels. It is not a valuation exercise. It's a liquidity exercise.
All right, playbook time. If you're an operator, an angel, or an LP watching this space, what do you actually do? 4 steps: free, boring, and repeatable. Step 1, read the tender structure, not just the headline price. Who's eligible? What's the cap per holder? What's the pro-ration if it's oversubscribed? Step 2, separate the primary and the secondary in your head. If the last primary round was at, say, $12 billion and the tender clears at $9 billion, you have 2 data points. You don't average them, you interpret them.
Step 4. Think about tax and hold period before you tender. QSBS eligibility, long-term versus short-term, state residency, AMT. If you don't run those numbers first, the tender is not doing what you think it's doing. 4 steps. Free. And if you internalize them, you stop confusing "I got liquid" with "I priced the company." Those are 2 completely different sentences.
So here's the parallel, and this is the loop we opened at the top. 10, 15 years ago, employees at a wave of pre-IPO consumer companies saw tender prices printed at what felt like the real number. Some sold at the tender, thought they'd captured the value. Others held, watched the IPO price 2 or 3 times higher, and told themselves they were geniuses. And a third group held, then watched the IPO price come out lower than the tender because the tender had cleared into constrained demand and the public market didn't want the stock at that price.
Daily research at gp.advalorem.io. Free. We cover pre-IPO markets, warrant portfolios, allocation mechanics, and yes, how tender offers actually clear. Community lives in Discord, link in show notes. If you're building agentic infrastructure or trading on secondaries, our team runs live production systems at mev.advalorem.io and a warrant research catalog at market.advalorem.io. Not deals, research and infrastructure. And if you want to sit down with other operators who think about this stuff in person, we keep an interest list for community dinners. Reply to the newsletter or apply at tidycow.com/advalorem/syndicate. No pressure, no pitch, just conversation. The number on your cap table isn't the price. It's a data point. So do your homework, then decide. Share this with the operator on your cap table who needs to hear it.